Right. Thank you, everyone. Good afternoon. So my name is Eugene. I'm from Nikko Asset Management. I'm the ETF Business Development Director of the firm, and I represent our ETFs to the investing public in Singapore. People ask, what's my role? My role is to ensure, or hopefully ensure, that when you think about ETFs in Singapore, when you look at consideration set, you do look at our ETFs when you want to see what you need, what are the building blocks that should go into your portfolio. Looks like I skipped a couple of slides. Okay, so that's my title today, Fixed Income Investing Amidst Volatility. I was just at the back of the room, and there was a slide showing portfolio construction for the balanced investor. And I noticed that 50% of that portfolio was bonds, right? And now the question is, why bonds? Some investors have come up to me and asked me, in the recent climate, in the wake of maybe last year S&P 500, US equity stocks, some tech stocks doing extremely well. And in that context, they asked me, why bonds, right? If I can potentially get 30% capital gains in a year, why am I looking at one of your ETFs or Singapore government bonds, just as an example, which maybe gives you about 4% yield per annum at most, right? But I think the question is, and I asked my portfolio manager that, right? This is just his experience. He was a young working adult at about the time the global financial crisis hit. He was his entire portfolio was in equities, stocks, which when the going's well, when it's all hunky-dory, it's great. But when he came to realization that he could lose his job and lose almost all his investments, that's when, at a visceral level, at a very personal level, at a survival level, he realized that maybe he should be looking at bonds not individually, not right in an isolated manner, but as a core part of his portfolio, right? Because in a way, these are really what you will need if you are faced with a crisis, existential, career, etc. Right? So income generation, bonds do pay coupons on a regular basis, and depending on the credit worthiness of the borrower, you should be guaranteed to a certain extent your principal, right? But on a regular basis, there is some income generation. There is that feature incorporated into a bond investment. Portfolio protection. So this is what I was alluding to. In a crisis, bonds, because of its negative correlation with equity in general, right? They are negatively correlated. So an analogy would be when a ship is sinking, right? These are the lifebuoys that help you stay afloat. Diversification, this is away from equities. So once again, diversifying away from a single asset class, right? Adding bonds to your portfolio. You may also add other asset classes, commodities, maybe even some digital assets, bitcoins, etc., etc. But then again, diversification as an ETF business development manager, the number of times I say diversification in a professional context, if I get $1 for every time I say diversification and why it's important to investors, I would probably be a lot richer right now. Okay, so these are really the three reasons I've highlighted that I want to highlight today why you should consider bonds. Right, income generation, that's built into the asset class, portfolio protection, right, because things could go south pretty fast, and diversification. Now, this is the Singapore fixed income complex, right? So this is just a simple graph that graphs risk and reward and the relationship between that. If you move to the right-hand side of this chart, it means you're taking on more risk. And if you're taking on more risk, what do you require as an investor? You require something more, right? In terms of ROI, returns on investments, right? So you can see right on the top here, we've got high-yield bonds. We have a booth downstairs on the 5th floor, and people ask, there was some investors that asked, right? Maybe I invested in some high-yield bonds, maybe some China property bonds, etc., etc. It did terribly, and that's true. But that's because, once again, I'm sure the returns were high, but that also means that the risk and the volatility of the investment is also high, which is why it's at the top right-hand corner of this matrix here. But right on the bottom left-hand corner, what do we have? We are Singaporeans. This should be quite familiar to us, right? The popularity of SGX, Singapore Government Securities, or T-bills, treasury bills, etc. This is where those assets, that asset class lies, right? Very low risk, low volatility, backed by a AAA rated Singapore government, right? But you're not going to shoot the daylights out of the investments with these asset classes, right? The returns are obviously going to be a bit lower. So that's where you would be in this matrix. Now we go to quasi-government bonds. We're familiar with issuers like HDB, LTA, SingPower, right? So quasi just means, generally, it just means like the government, like it's similar to government bonds. So Singapore government bonds, quasi-government bonds, because it's just a bit like government bonds, you see them move up, diagonally up and to the right of this matrix. Then investment-grade corporate bonds, we'll cover that in more detail in my later slides, but this is where you take on credit risk. So maybe not as safe as a borrower, as an issuer of debt, but still generally safer than where we see the high-yield bonds occupying in this matrix, right? So investment-grade corporate bonds. Okay, just for some context, so we have got Nikko AM, we've got 2 bond ETFs. You can find out more detail about it later if you meet me on the 5th floor. But we've got the ABF Singapore Bond Index, that's lower on the left-hand side, and the Singapore Dollar Non-Sovereign Investment Grade Index. What do you think I'm trying to, once again, if I say this word and I get $1 every time I get it, every time I say it, what concept am I trying to illustrate here? No, I'm talking about healthy living, right? Okay, well, but I think even in healthy living, okay, jokes aside, even in healthy living, you need diversification, right? You can't, humans can't subsist and survive on just eggs alone. You've heard the saying, don't put all your eggs in one basket. Similarly, for investments, for health, for almost everything in life, right? Do diversify. And this is just one picture that I want to leave with you before I move on to my next slide. So diversification is important. Either diversify away from an asset class, or in this case, diversify in terms of the types of bonds that you want to invest in, right? If the balanced portfolio was 50% bonds, right? Do you just buy one bond and say, good job, done, I'm out of here? Or would you prefer to buy a basket of 50 bonds so that, touch wood, maybe one bond does happen to go on default, right? There's still another 49 that gives you that diversification benefit that could boil up that portion of your portfolio up. So this is the credit rating chart, right? I'm not teaching ABCs. I leave that to kindergarten school teachers, but it follows a very simple matrix, right? AAA just means the best of the best. Very unlikely that the person that you are lending money to would default when principal payment comes, when the bond matures, right? So let's say you invest $100,000 in a particular bond with an issue of a AAA credit rating, the Singapore government, for example, at the end of the maturity period, whether it's 2 years, 3 years, 5 years, 7 years, they would give you back that $100,000. What do we see right at the end, at C or even D, which means default, or another, well, colloquially, dead, right? It means that it's very unlikely that you get any of the money back. If you're lucky, it goes into liquidation, etc. Maybe you get 25 cents to the dollar, right? So once again, this is the spectrum of risk that is available for bond investors. Not all bonds are issued equal. You have to look at credit rating. So where do Nikko AM's bond funds lie? Right at the top. AAA, really because of the underlying. Understand what's in the underlying portfolio, right? AAA rated, average credit rating AAA. Move down a bit, still safely within the investment grade spectrum in the blue area, investment grade corporate bonds. Okay, so this is, right, just have at least a nominal understanding of credit ratings and why it's important to you as a bond investor. Not all bonds are issued equal. Now there's this thing called spreads, right? When we look at, when I say you go up the credit curve, that means when you go from AAA to single A, for example, you demand more, right? You demand more returns from the issuer, the person borrowing money from you. in simple words, you're asking for a spread over the risk-free rate. So if the risk-free rate, as suggested here, is, let's say, the Singapore government 5-year treasury yield, right? You can see it's hovering around 2%. It's gone up to about 3% recently, in recent years, right? So this is as good as a risk-free rate. That means it's almost risk-free lending to the Singapore government. But now I'm lending to a Singapore corporate. The Singapore corporate could be DBS, could be UOB, could be Temasek, could be Changi Airport Group. But because they are slightly more risky, I demand a spread between what I would have gotten from the risk-free rate versus what I'm getting now because I'm taking on a more risky investments. And traditionally, the spread between these two asset classes within the bonds sector is about 100 basis points or 1%. Okay, and you can see that it is narrowed here, right at the corner. You can see that government bond yields have gone up, but the credit spreads have maintained, it's kind of steady. It's actually trending in the slightly opposite direction, it's trending down. Okay? So this is, once again, right, the risk-free rate, just measured and presented in another manner, right? I'll just read it out here. Spread levels represent the credit risk when investing in these bonds. The higher the risk, the wider the spreads. So once again, same way of presenting, different way of presenting the same data. Whichever way works for you to understand what credit spreads are, what you should be getting for getting more, putting on more credit risk, whichever helps, right? Use that. Okay, so now when markets are concerned with economic outlooks, right? Some questions I get, is a recession around the corner? I don't have a crystal ball. I'm not a macroeconomist. I'm not a trained economist, right? But we do know that generally when economic outlook is uncertain, credit spreads widen, right? Because, yeah, you're rewarded for taking on more uncertainty, right? And on a bond level, issuer fundamental credit quality, bond structure, liquidity also affect the levels of credit spreads. Just on that last note, this is something that I'm sharing at the end of my slide, but there's this portion here about bond structure, which is important to differentiate the two ETFs that I'll be sharing next. Before I get there, there's another, other than credit quality, there's this matter about yield, price, the inverse relationship, and duration. Okay, the spotlight is quite bright, but is anyone familiar with duration and the concept? Just for me to... Okay, I can't see any of you. I don't see any hands waving, so I will go to duration 101, right? So yield and price. Yield goes up, what happens to price? Goes down, okay. And then yield goes down, what happens to price? So as a bond investor over the last, well, since let's say 2022, we know that the central banks have been raising yields at a very rapid pace. And what has happened to bond investments? The price has come down, okay? And how sensitive is your bond investment to that increase in interest rate? You will look at duration as a measure, right? So just think of it as a seesaw no, sorry, is it a seesaw or swing? Seesaw, right? I'm getting my playground mixed up, okay? So imagine if duration is very long, I press down my side of the seesaw, and if duration is 10 as a measure of the inverse relationship between yield and price, yields come down by 1%, rule of thumb, generally prices would go up by 10% because duration is 10. Just multiply one by the other. But by the same rule, if yields goes up by 1%, your investment, the price goes down by 10%, if duration as a measure is 10. So, rhetorical question, if you expect yields, right, yields have peaked. I'm not sure when they'll start to bring it down, but if, let's say, the expectation in the medium term is that yields will eventually come down, interest rates are going to come down, and you think you want to position yourself to take some risk, would you invest in a bond portfolio with a higher duration or a shorter duration? there's actually both answers are correct. It's your risk appetite. If you're quite certain, maybe your crystal ball is clearer than mine, maybe you know something I don't. If you're quite certain that interest rates are going to come down, you may be a bit more aggressive. You look for bond portfolios with a higher duration so that when interest rates come down, you benefit more on the upswing in price. But if you're not so certain, maybe you look for something with a shorter duration, right? So this is just an example to illustrate, right, how you can think about positioning yourselves in different asset classes using potential interest rates movement as the driver of any growth. Okay. This is just an example of a worked example of we just use a government bond, right? And then how when bond yields move up or down, the bond price has got its subsequent movement. And then this just describes whether it's trading at discount, par, or a premium. Okay. So market outlook, and these I do have to say that this year it's been difficult, right? These may change, right? The Fed may wake up tomorrow and say, okay, we're going to lower rates 9 times, right? But as from what our portfolio managers, from their read of the market, is that there may be some short-term volatility in the near term, right? And the markets, right? Everyone has got their different crystal balls. Some are yellow, some green, some blue. They're debating, right? When is the timing of the first Fed rate cut? All right. But in general, I think there is a growing belief that peak rates are behind us. And they are positive about duration in the medium term, right? You can agree or not agree, right? It's on a spectrum. So with your understanding of duration now, I hope I've been a good teacher educating you on duration, right? Then you can position yourselves, right? Find a right product that fits your duration requirements. Corporate bond yields have declined from peak, but I think I'll show a graph here. It's still attractive at historical levels, so you can lock in these higher yields, right? And then wait for potential capital gains. Singapore bonds will follow the downward momentum of global yields, right? Because Singapore yields do follow the US Treasury yields directionally. And so Singapore dollar corporate bonds should be seen as a favorable asset class. The bond market, in terms of issuance every year, it's quite healthy, right? Risk, of course, it's sticky inflation, right? Inflation is the thing that caused it all, right? And geopolitical risk. Okay, so I think there's quite a balanced view, and it really helps you. Well, me personally, position what I think would do well in an environment when interest rates start to come down. Okay, and we mentioned Singapore dollar, right? Anyone traveled to Japan, Malaysia recently? Show of hands. Anyone enjoyed the strength of the Sing dollar? Right? From a 5-course omakase now, suddenly you can, I can afford a 7-course omakase. Yeah, really, because of the strength of the Sing dollar. So, as a Singaporean, I particularly enjoy the strength of the Sing dollar. It's not something that I scoff at. I actually appreciate it very much. So personally, I would also look at Sing dollar denominated investments in 2024. Okay, so I alluded to what's inside, what's the secret sauce, what's inside these 2 baskets of bonds, bond ETFs. On the left is the ABF Singapore Bond Fund. You can see most of it, almost 80% of the holdings is Singapore Government Bond Securities, right? HDB next, LTA, Temasek Financial, Sing Power Assets. Now on the right-hand side, corporate bonds. Which types of entities are issuing these bonds? Mainly at about 30%, banks. Stat boards, so HDB and LTA are included, part of it as well, about 26%. But then you've got a whole other slew of issuers. Insurance companies, REITs, investment companies. So a lot more diversified. Why do I show this chart? Because once again, $1 for me, diversification, right? Because instead of buying, if you go to a wholesale market and say you want to buy a DBS bond, for example, in a wholesale market, the minimum ticket size is 250,000 thereabouts, 200 to 250,000, right? Then you get exposure to one bond at 250,000. Whereas with an ETF, if you wrap it all up, you diversify it, you get a basket of about 50 to 100 bonds, not getting exposure to just one issuer, and the minimum amount that you can trade on SGX and on FSMOne is like 1 unit, which is about $1. Okay? Now, weighted average duration, you can see here, one is longer than the other. ABF, 7.5 to 8 years as a measure. Investment grade corporate bond, 5 to 6, 5.76 years. So rewinding back to duration 101, my lecture previously, which one would swing more in response to interest rate movements? The ABF, right? Because the duration is longer. And general rule of thumb, duration, anything above 7 to 10, that's considered long. Medium would be anything 3, 5, 6 maybe, right? That's considered medium-term duration. And then short duration, it's anything 1 to 2 years, 3 years, etc. Okay? So last time I used to wonder when I read analyst reports, and sometimes they speak in jargon and they said, we're positive on duration. We want to add duration. Until I figured out what duration actually was and how it affected my bond portfolio and how it would react to interest rate rises, I didn't know what they were talking about. Yeah, I didn't know how to position myself. Okay, so this is the first one, the ABF Singapore bond. This is the index that the ETF tracks. You can see currently, when we look at it historically, we stretch the data back for 10 years, quite long. You can see at 3.35 for AAA rated issuer of debt, giving you 3.35% yields historically. Number one, it is at almost an all-time high over the last 10 years. But I don't know, when I look at it, when my portfolio manager and I look at it, we see this as maybe a once in a decade kind of opportunity to lock in these yields. Because we have not seen these yields for the last 10 years. And maybe at a point when COVID hit, when there was a little bit of panic in the markets, equity markets were tanking. This is where a safe haven asset like Singapore government bonds does well. But now we can see at 3.35, it's at similar levels. So historically, I think this is why we say it's a good time to lock in some yields. What do you think my next slide would be the investment grade corporate bond yields would be like? What do you think it would be like? Do you think it would be similarly at historical highs? Better or worse off? Slightly worse off in terms of yield. Right, you can see that yields have come down, but still, if you still want to lock in some yields, the good news is that it is still generally at historical highs. But what this also shows, you can see that after the peak yields of almost 5%, sometime end of 2022, when I think that was really the end of that massive rate hikes from the Fed, it has come down steadily, which means that as yields come down, well, the prices and the returns have gone up. And you can see that in my total return chart, calendar year returns, 2022 was a bad year, but in 2023 it picked up. It was actually a good year for bonds, for this ETF, 8.6% returns. And this year to date, it's at 1.9. Okay? So you can see that both ETFs reacted differently. Now, before I go through this chart, so investor types. Number one, maybe know yourself as an investor, but some conversations I've had would be, I am close to retirement, or maybe I'm retired. I do not want to put too much risk on my portfolio. I want something that can tide me out in the medium to long term. I want something that isn't too volatile. I want something that isn't too sensitive to interest rate changes. And looking at these charts of both these two different strategies, which one do you think would be more suitable? And this is charting the NAV of both funds. And this is quite recent, so this is the last year. But you can see that on the left-hand side, right? Left-hand side, yeah, the ABF. The reason why the prices of that, this portfolio has come down, the ETF has come down, is really because of interest rate pressures. Interest rates have not come down as much as expected. Well, essentially, the higher for longer market outlook continued. And that's why the ABF ETF suffered. However, similarly, you would have expected our Nikko AM investment grade corporate bond ETF to similarly suffer, or maybe to a lesser extent, right? Because we still have the credit spread, remember? That acts as a buffer. We should have seen some kind of pullback in terms of price. However, it did not really pull back. My guess is because it's really, once again, in my previous slide, I said there's this thing called bond structure, which we seldom speak about, because I think this is more bond ETF 201 bond structure, right? The investors in the investment grade corporate bond ETF seldom sell when there's volatility in the market. So if people are not selling, investors are not really rushing to sell, even despite volatility, even despite some fears, that actually gives it some holding power, which I only really saw when I did this chart just earlier this month, right? So I thought this was interesting, right? This is something that I don't seldom get to talk about, bond structure, right? I know I spoke about this particular ETF at about this time last year. And even then, I did not have the data to show that even when interest rates, the higher for longer risk factor, right, continued, the ABF suffered in terms of price, right? But the investment grade corporate bond ETF maintained actually quite well, right? And the factors behind it is, number one, what do you know? Starts with D, duration, shorter duration, right? So less sensitive to interest rate movements. So that's one. Number two, market structure, right? It seems like the investors in this ETF over the many years that we have been running this ETF there's no less, for lack of a better term, panic selling, right? So market prices have held up. And number three, there's a credit spread, right? So because it helps you buffer against any kind of interest rate movements. So because of these three factors, you can see the difference in the direction of the arrows in the short term over the last 3 months. Okay, but now I think we've gone through a lot of, right? It may be a bit. I do know that I may have been going a bit deeper about the different ETFs and the structure and the product features. But I'll just end with this, right? Why do I still think there's a case for Sing dollar bonds? Number one, as I mentioned right very early on, you may be in a position like my portfolio manager, as a young portfolio manager, faced with a crisis where equity portfolios don't do so well. From that lesson, he always wanted fixed income as part of his portfolio just to give him diversification away from equities, right? So that's the one. That's the very first line I have there. Investment grade corporate bonds can provide diversification, greater certainty of income, okay? Interest rates have significantly adjusted from their low levels, relatively attractive from a historical perspective. Both are relatively attractive, just that the ABF, well, because of its sensitivity, is a bit more attractive, right? Yields have gone up again, right? But even then, the corporate bond ETF is also relatively attractive. Now, investment grade bonds, once again, stable credit spreads, around 100. Yeah? Right? And really that offsets the impact of rising interest rates. But eventually it would get eroded. So I think this helps illustrate that third point there, right? It's at least the first line of defense when interest rates remain higher for longer or, well, touch wood, continue to go up. Now, you may think it's all doom and gloom for, sensitive, for let's say my ABF ETF, right? But they still perform best if and when there's a risk-off market. So rewind maybe 3 years when COVID hit, when equity markets were spinning out of control, right? That's where safe haven assets like Singapore government bonds or the derivatives of it, like the ETFs, do quite well, right? And then because of duration, once again, yeah, what's the real driver here? What's the real concern about markets right now, which is really taking up a lot of attention and a lot of debate, as you mentioned, is interest rates direction. Because the part of its feature, duration is longer. If interest rates start to come down, because of its longer duration, the potential swing, right, capital gains that you get from investing in a long duration product, it's higher. Okay, so I'm correct. This is my last slide. I hope this was useful. I hope this was illuminating. There are some topics that I touched on which I don't usually touch on. So thank you for giving me this opportunity to speak to you over the last 20 minutes about some topics. But if you've got any other questions, you want to know more about our bond ETFs, our Singapore dollar bond ETFs, or our other suite of products, I'm on the 5th floor. My colleagues are also on the 5th floor. We can answer those questions with the benefit of more time. Okay? Thank you very much.
Thank you very much, U-Jin.